Hello folks, Brendan Chapman with you today. It's another Wednesday video. Normally I'm on Mondays, but today I'm on a Wednesday. So anyway, it's good to be with you. We're talking the market. We're talking about the late day rally that reveals the key level to watch in the S&P 500. Go figure, right? We're going to talk about that. We're going to look at some of the interest rate expectation changes and how that's impacting the market, particularly interest rate sensitive parts of the market, like, for example, financials, real estate, etc. Then we'll look at gold and oil as well. So that's the direction we'll kind of take today's video, but let's kick things off by taking a look at the S&P 500. We're going to look at the levels. We're going to talk the VIX and VIX-related indicators that might give us an indication of how much we are into the sell-off. Now, if we're looking at the ES, obviously this is trading throughout the course of the day. You can see that we have this longer shadow on the lower side. The body is still bigger, but notice the late day rally in the S&P 500. Now, this is the futures. Now, I like to use traded products during the kind of the cash session. This is the SPY. Now, if we look at the candle on the SPY, what you're seeing is kind of that overnight gap down. We traded lower, we traded higher. And what happened is, and I've got a marker here just to kind of reflect that trade price, and you'll see it over here on the trade flash, 1.65 million shares at 471.70. And so that creates a key level. If we're below, it's bearish. We start to break above it, maybe we're establishing a level of support. But what this does do, it gives us a key level to watch in the coming week. And what happens is we also, look, we had a large print from January 3rd, just below here, 469.73. So we have as a couple of levels, right? Even down here a little bit further. We have a couple of levels that have been respected in the past. We kind of broke through this and led to this rally. That's the relief rally. We had a significant print up here at about 477 something. We failed, we fell back, and now we're just hovering above a key level at 471.70. Now, again, what happens is a lot of people look at, for example, like volume profile. They try to look back and add up all of the trades that occurred at a specific level and create a potential range where the price may hold. These one kind of trade prints, 1.65 million shares in one print, creates an instant level. And these instant levels have become more frequent over the last few months. In fact, this is paralleling what we saw, for example, back here in 2021 before the decline. And so we've got to be really kind of careful at this point. The same level we saw, for example, back in 21, in the beginning of 2022, before we saw a more significant sell-off. Again, the frequency of these large prints have picked up in the last couple of months. And so as we look at the market, we have these levels, and as we start to break away, in particular that 467 level here, we're looking at something a bit bigger. But again, these levels that pop up help give us a key point. So for example, tomorrow, if we begin to rally off this point, don't worry that this is a buy order. Someone had to sell into it too. The fact of the matter is, what we're trying to identify is the price level. The price level of 471.70 becomes instantly significant, and the fact that we were able to rally above it, we opened up at that level, we rallied above it, suggests maybe we have some short-term opportunity. So what you'll want to do is look at, for example, today's high. If we can gain some traction above today's high, maybe we have a chance to make a run back at 477 again. And then we'll test that other level again. If we begin to break through this level, now we're watching the low for today. And if we break that point, we have another level down here, 467. And man, we start to take that out. This is where the market may really start to sell. Because as we look right now, for example, let's look at the VIX today. The VIX, fairly muted in the amount of movement we're seeing right now, right? We're not seeing the bigger moves like, for example, back on September 21st. We're not seeing a big gap like, for example, we saw back on August 2nd, or even the sell-off like for example, we saw last March of last year. We're not seeing that right now. What does this tell us? The market and the institutions are basically delta comfortable. They're okay with how the market is trading. They're okay with the fact that maybe we're pulling back right here. They're repositioning themselves. For example, staples really led today. If we look at a list of S&P 100 companies, S&P 500 companies, for example, what do we have? Healthcare. We got Humana in there. We got some trading, exchanges, CME, SIBO. We got Smuckers. Smuckers is a dividend aristocrat, right? We're consolidating right now. Looks like a flag pattern. We start to break above the highs. Expect this to probably close the gap. Dividends not amazing at around, well, it's okay at about 3.25%. But the point is we're kind of reversing and we're forming, normally this would be a continuation pattern here, right? We got kind of a cup and handle. It's not exactly a continuation because we have a downtrend, but at a minimum, we have this kind of rounded bottom. We're consolidating. We're testing the high of the gap day. We break through here. Again, 140, maybe even back to 160. Okay? If the fundamentals on Smuckers were reasonable, you got the $1.06 dividend, and what can you do? You could go in and potentially use that $1.06, which the next X dates when? 1, 2, 3, probably mid-February. You come out here, buy it in April. What could you get for $1? You could buy a 110. That gives you a guaranteed opportunity to sell Smuckers at 110. What if you want less time, right? A Feb 16, for example. $1 maybe come out of pocket a little bit, a 125. Now all of a sudden you've insured your stock. You've got an insurance policy at 125. If the stock breaks down and you hold likely through the next dividend, right? 11/16, maybe it's Feb 16 it comes out on expiration day. All of a sudden, you're the receiver of the dividend, pays for the put that you're buying, and you've got the upside here over the coming months. And you have a little bit of protection over the course of the next month, maybe encompassing not the next earnings, but the next dividend, ex-dividend date. Just some thoughts here, right? But what we're seeing is go down the list, right? Campbell's, ConAgra, we got United Healthcare. It's a healthcare stock. I mean, as you keep coming down, what you're seeing is we got Kellogg's down here as well, CL. I mean, these are all what? Mondelez. We have all these are consumer staple stocks. This isn't exactly the most bullish day you're looking for, but what it indicates we're maybe seeing rotation into consumer staple dividend paying names. All right, this is not setting the market up for an excellent opportunity in the near term here, right? What is creating this dynamic? Well, let's look at treasuries. Let's go to TNX. Okay, TNX. TNX, treasury yields are rising. We're kind of discussing this likely possibility of yields backing up the truck here just a little bit, 4.25, 4.4, 4.5%. This was a one-way trade with the expectation that the Fed was going to cut rates in their upcoming March meeting. Those expectations are kind of peeling back a little bit with some of the data. Retail sales were stronger than expected today. This was a little bit lower, but this was upwards of 80% not a couple of weeks ago. You can kind of see the pattern. This is the March meeting, right? Kind of see the pattern here. We were at 64%, 63, 57. After some of the statements early in the week from Waller, for example, we're starting to back off this notion that the Fed that are likely to cut in the next meeting. And this doesn't fully capture everywhere these probabilities have been because we don't have every single day reflected here. But the fact of the matter is this has diminished a little bit. This glimmer of hope of the Fed cutting in the March meeting, providing the stick save for the market, the Fed put, all of a sudden we're starting to ease back in those expectations and we're starting to see yields rise. If we're to look back here, this peak was developed as the Fed was looking to be on hold. When we began to see the breakdown here and the buying to the 10-year treasuries, this occurred as the Fed's expectations for interest rates for next year were looking at cuts as early as March. Now where do we go? 50-50 probability if we're going to cut or not? Are we going to back up maybe to the 50% retracement? And what kind of near-term pain does that create? Well, if we look at interest rates sensitive parts of the market, The two most interest rate sensitive is real estate and utilities, both of which broke key levels of support today. Utilities broke below the 1221 lows, and we look at XLRE, we broke below what? The low from January 5th. Okay, now this is kind of a long-legged spinning top, more of an indecisive day, but this is also a breakout. And volume is not as significant on ETFs, but the fact of the matter is you start to break stuff down. MPW is a medical properties ETF we've been following on the bearish side over the last couple of weeks. But again, volumes generally are big on the downside here. For example, we're looking at Realty Income Corp, dividend stock, dividend aristocrat stock, volumes aren't as high. Let's look at AGNC, mortgage REITs, very interest rate sensitive. AGNC down today, volumes aren't as high. But if you go down the list of various REITs, some will be more, some will be less. But the point is, these are all companies that are very sensitive to interest rates. They got the boost from the falling yields on the 10-year Treasury, kind of setting expectations or reflecting expectations. And now we're wondering, after all the rally, where do we go from here? If we look at some of the activity today, we look at, for example, XLRE, since we already looked at it, XLRE. XLRE today, there's a roll, and we look here at the Fed 40s right here. It was in the money in Jan, closed out the 41s, rolled it down to the 40, taking something out of it, right? IYR today, but still, right, maintaining an in the money long put on XLRE. IYR today, another ETF. This is a 26 Jan expiration here. What's going on? Buying the 86, selling the 84? Okay. We could come down here. I had it written down a little bit different. Let's take a look. Option time and sales. We'll just sort by quantity. We'll clear this out here looking at the put side. And what do we got? 55, 55, a spread, right? This is kind of reflecting at the bid. Point being, though, this is still what? 19 Jan, kind of mixed up here in a little bit. But the point is, we look at the amount of activity. Oh, it's 19 Jan. We want 26 Jan, dang it. Let's come in here. We'll change the series to 26 Jan. And what do we got? Look right here. For example, a spread, right? 87 and 90. That's 19 Jan. Why is it not reflecting 26? I still got 19 checked. All right, now we're starting to find it here, right? 86. These were not spreads. Okay, it's not a spread. Kind of made me wonder as I saw that activity here. But this was what? The 26 Jans were bought today, right? 26 Jan right here at the 86 strike for 26 Jan. What are we looking for? We're looking for downside. 86 strike right here. Well, guess what? I mean, as we consider potential trade opportunities, give yourself a little time, right? The vol skew is favorable. Buying 87, selling 85. Is that reasonable? Right click here, buy deep and wide, 1 month, 2 strike vertical. 62 cent debit. We're probably around a 40 plus delta on that one, 41 delta at the 87. High probability we get in here. Break even price level is 86.38 at expiration. Okay. So the pricing's favorable. We got the breakout. We've got time to allow it to retest, maybe even retest the highs and come around. But again, interest rate sensitive parts of the market. If rates back up here or the perception of risk changes, okay, we have additional downside here. And looking at a trade out there a little bit, expect IYR to probably underperform. But if the S&P even retests our prior highs back here, again, you have time for it to come back around. I had this happen on ARK, for example. Talked about, a bearish vertical trade back here. I had taken one back here. Gave myself till Jan 19. Market rallied and finally came back around here today. I ended up closing it out because it's pretty oversold in the near term for like an 11% loss. It was a max loss up here. But you give yourself a little bit of time, there's opportunity for it to come back around. And if the pricing's good enough, you got a good chance of getting back to break even or even maybe a small profit, even if the trade goes against you. Now, obviously, we're not expecting IYR to make a massive rally, but you never know what happens, right? Stuff gets crazy. But the point is, we're just breaking a support level today. And if yields stay high, we start to see diminished expectations of a Fed rate cut in March. This only is going to create additional downside pressure. Also, for example, in stuff like HYG breaking down off the highs today, right? So interest rate parts of the market. MPW, let's talk medical property since we just already mentioned it, but MPW today. And we've seen this one again. I've been following this a lot. We'll kind of just minimize this and that. Look at the 26 Jan expiration here. The $3 strike price. Right there at the $3, 26,000 contracts today. We've seen activity on the $3, the $2.50, looking at additional downside. Can you just consolidate this and say, okay, IYR, XLRE, and play the downside there? Sure. It's one way to kind of play this interest rate trade. Well, what about banks? Now, interesting enough, I mean, banks were not as bearish today, right? KRE is one I've been kind of waiting for it to break, and I gotta put vertical on this one, but we're kind of heading lower. We rallied off the lows. In fact, financials ended up being the second best performing sector in the market today. But again, if we see a turn, right? If we start to see interest rates raise sharply higher, for example, inflation, again, poor performance in bond auctions, diminished Fed expectations, we see this run. What's going to happen to KRE? Look back last year. Granted, they have a facility, right? The Fed has it in position. Are we going to see a free fall like last year? Probably not. But we've seen a decent amount of bearish activity. In fact, last Friday on KRE, or Thursday rather, looking at the downside. Okay, so banks are another one of those places. What about something like, for example, SYF, Synchrony Financial? This is just starting to see the turnaround. Unfortunately, they've got earnings coming up here, but Synchrony Financial, a little bit of put buying ahead of the earnings here at the $36 strike price, $37 strike price on Synchrony Financial. Again, does it make sense that this stuff, we've already seen some selling in areas of the market? For example, energy has seen some significant selling. What hasn't? What about technology? We saw the relief rally last week, the retest the prior high. Where's this going from here? Where's NVIDIA going? We talked about in last Monday's video, getting long semiconductors. Where do we go now? Those targets are reached. SMH, we talked about last Monday, targeting this prior high at 177. 176, we got there yesterday. Now what? So is all of a sudden, is energy going to come off the lows? Real estate, utilities? Is this where we're going to go? Again, the interest rate sensitive parts of the market are not an area that's going to perform well unless we start to see a bid in the bond market. Now, Staples is a little bit different phenomenon. Staples is held up. Staples, we're seeing rotation to stuff like Smuckers. Real exciting. If you're in a jam, look at Smuckers. sorry for the pun there. Okay? So the reality is a lot of the opportunity is still looking at the downside. One area of the market is an industry that's held up very, very well is what? Home construction, ITB. We're testing prior highs. We've been backing off for the last couple of days. We had this free for all almost where we're getting a strong bid as yields are coming down, mortgage rates are coming down. All of this optimism, again, is this founded? One might suggest probably not. And so as we look at ITB today, let me bring it up here. This was actually got it written down on my list. Got to find where it is here. We got a 26 Jan expiration. What's going on is they're selling the calls at 103, buying a put spread 99.95. You don't have to sell the calls here. Okay? You don't have to sell the 95s. You could buy a 98 and sell a 96. It's going to cost you what? 35 cents approximately. You could buy the 99, sell the 97. Cost you about, about 45, 55 cents. Again, just looking for downside retesting the prior low here. You start to retest that or break through it a little bit, that spread will play out. There's 9 days left. Okay, this will maximize quickly. Why sell the 94.50, 94 of 95 in here? Still 20 cents. This costs you what? It allays some of the negative theta here. Keep it tighter, it'll maximize more quickly. The risk and reward of going this wide is much greater, of $4, and it's costing you about what? 80 cents, 90 cents? Okay, so not a bad deal, 85 cents probably. Again, that's not a bad trade to consider if you want to give yourself more time to be wrong. Look at February, 99.97. Okay, maybe it costs you 75 cents. So the point is right now there are spread opportunities to play the downside. You could even give yourself out to March. Sorry, no, we don't have March 1st in this one. Less open interest. Again, the spreads are a little bit wider. Probably stick with 16 Feb. Okay, so if you want to play the downside of interest rate parts and sensitive parts of the market, a lot of this stuff has held up really well in face of the rally we've seen in treasuries. Sorry, the sell-off we've seen in treasuries. This may continue. Okay, but again, we've got these key levels. We may see a bounce here. Makes sense if we do. Again, institutions are delta comfortable right now. They're okay with their exposure. We're not seeing any panic. But again, what happens? We start to break this level in particular. We start to break 467 on the SPY. This may be where we start to see the bigger selling and liquidation instead of rotation. But the fact that all sectors are negative today shows we're not seeing any big rotation, but a rotation in staples we saw at the beginning of the year right here. We're just seeing more of that kind of bleed in. And so I would argue there's probably been a little bit of accumulation despite the fact the price has gone sideways in staples. And I think today kind of reflects that with some of the performance in some of these consumer staples names. Okay? Let's turn our attention to oil right now. /CL. I mean, all of this news coming from the Middle East, right? The dynamics for oil, I mean, are we in an oversupplied market right now? Look at the 5-year supply range. We're towards the low. Yes, we have relatively high production, right? Record high production right now in the last week. So again, we're seeing more production, but the supply, right? And we have geopolitical risks. Oil's down here at 67.50 recently, and we're just consolidating, getting to the apex of this symmetrical triangle. Where do we go from here? Let's look at the product depth, /CL. This reflects the product curve over the past, number of weeks. Okay? Notice where we are today. We're going from kind of a hump to a slump, right? We have what's called backwardation oil. It's very minor, but it's a shift that's happening right now as oil has been forming a support over the last little over a month. Is oil poised for a breakout here? Okay? The oil market right here suggests that because this slope is down, it suggests the risks right now are to the upside in oil. Backwardation allows a product like USO, for example, to perform well as the roll. There's actually a positive roll as you go from one contract, you go from here to there. That positive roll is very, very minimal, but it's not negative. This allows USO to potentially outperform. What about oil stocks? We'll look at Buffet's favorite, Oxy, trading at lows down here. 1, 2, 3 tests. Close on a 4th test. We're back here again for a 4th to 5th time. Is this a point where the risk and reward for a stock like Oxy may play out positively? So Oxy today, there was some bullish option activity in it out in August. Plenty of time out here with an August expiration. But again, we're out here at the 67.50 strike. Is that an overwhelming amount of interest? No, but 67.50 is what? It's your prior high back here, isn't it? So the point is right now, oil price is consolidating. We're seeing on the back end, the product depth curve is showing that there's maybe a bullish case building as we're testing support, consolidating, and it may suggest the sell-off here in energy is a bit overdone. I took a trade last week in MRO as a spread. It's broken down the last couple of days. But there's a decent amount of rotation last Friday and stuff like MRO. It's failing right now. Do I know if it's going to get back up? I have no idea. But the reality is the fact we're seeing more energy trade coming here, and the bigger dynamic is what's happening with the product curve or the term structure of oil maybe is starting to crack open that door a little bit. What we've seen this week, though, if we look at gold, for example, the dollar's been strong. The last 2 days, we've seen a significant rally in the dollar on those diminished expectations. Gold has been under pressure. Yesterday, bullish activity in GFI. Falling back here the last 2 days did not materialize. We got to see some sort of support. It's early. But stuff like Barrick Gold today. Are we starting to see a little bit of a commodity trade begin to develop here? Now, the seasonal trade in gold is obviously cooked, right? It's done. But now all of a sudden we're oversold again. Where do we go, right? Today in Barrick Gold, it's a Feb expiration. We got a $16 strike price right here, mostly buying. So again, are we seeing some rotation back to these names suggesting the dollar, it's overdone it, okay? The gold's a very direct indicator of the dollar, but again, look what we had here, flag breakout. We got maybe a little bit of upside here vis-a-vis the euro since the dollar index is effectively 57% weight of the euro. But I'm looking for a little bit more rotation back to commodities again, especially if the market is going to hang in here, right? Is technology going to be the leader? To me, when we looked at it, we've seen the rally of the last week here, this speaks to what? It was just a rotation. It's a relief rally. We're going to start to see earnings in Apple, for example, in Meta, in Amazon. We've got all these companies in the next week or so that are going to announce. This is going to shape the next move in these monsters of tech names. Okay? So we've got some data coming up. Pretty hard to kind of get long this stuff right ahead of the earnings. And they may have a very big impact on the broader market. But the stuff that's more oversold, like, for example, energy, this could be a place if things shore up, if we still see some geopolitical risk, we could see some momentum here. Okay, still early. You may want to see a little bit of reversal, stuff like Oxy, MRO, CVE is another one that's seen a lot of option activity. It's sold off hard. But again, or you just go with the staples in here, right? Exxon, Chevron, these kinds of names. Oxy's probably in that mix as well. But again, we got to see probably a little bit more of a confirmation, a little more support forming, but just realize this stuff could turn fast, especially if what we're seeing, the indications from the oil market and the product curve is saying, look, we're starting to see the bullish trade shape up again in this space, particularly oil. Well, folks, we'll wrap it up here. I guess I had ARK on the list too. Let's quickly look at ARK. Missed that one. But again, I had an ARK spread, rallied and fell, closed it a small loss today. Very oversold here today. I was going to mention when you have, we kind of have a phrase here at TheoTRADE, don't short into the hole. What happens when you get a big sell-off like this? Right? It's tough. You see a trade in ARK today, certainly reasonable to say, hey, I'm going to wait for a little rally and then lean into it again. But if you're looking to take a stab here, notice these puts being bought at the 43 strike. The term structure is favorable. We're buying the lower vol, selling the higher vol here. You could construct a relatively cheap spread to the downside in case things really tip over. Otherwise, again, look for the rally, lean into it again on the bearish side as we get towards 48. Otherwise, again, if you want to put something out there just in case, this is like Tesla, Roku, right? Path. These have seen big kind of reversals here. If you think these stocks are going down, look at ARK. And again, kind of meme-oriented stocks, again, you could play that downside here cheaply and have a very high reward to risk. Otherwise, look for it to bounce back up again. No rush. But again, you're seeing more bearish activity coming in ARK today. Folks, we'll wrap it up there. We'll catch you back on Monday, my normal slot for the video. You have a great one.